Well, hello, everyone, and welcome. This is Cynthia Tomaine with Interactive Brokers, and thank you for joining today's session on active investing versus buy and hold. I'm very pleased to have with us qplum to deliver today's presentation, and I'm going to start off by introducing Ji Chen with qplum, who's going to give us a brief intro, and then we'll get into today's presentation. So welcome, Ji, and thanks for joining us.
Hi, Cynthia. Thank you very much. Hello, everyone. My name is Ji Chen. I'm a partner and head of client relations here at qplum. Our speaker today is Mansi Singhal. Mansi is the CEO and co-founder of qplum. Prior to creating qplum, she was a trader working at several banks in addition to being a portfolio manager at Brevin Howard, where she managed a book of over 100 million in assets. Now, qplum is an AI-driven asset manager using both deep learning and machine learning in its strategy construction. We provide asset management services to RIAs, family offices, and pension funds, along with endowments. We also have an online investing service to directly manage money for individuals and families. We actively manage individual, joint IRAs, trusts, and LLC accounts. Now, to all of our attendees, during the course of this presentation, please feel free to submit your questions along the way, and they will be answered at the end of the presentation. Okay, now, I will hand it over to Mansi to begin the presentation on active investing versus buy and hold.
Thank you, Cynthia. Thanks, Ji. So in today's webinar, we'll cover the following topics. We'll talk about buy and hold, and we'll call it the what if strategy. We'll talk about one of the most popular investor, Warren Buffett, of our time. We'll talk about your portfolios. How active are they? And where do you use active management in your portfolios? We'll also talk about how should one look at active strategies, how to distinguish between different active strategies. And then we'll also talk about how active is a US household on average. Some of the technical terms we will use, and I'm introducing the technical terms in the first slide, so in case somebody wants to write them down, get more familiar with them. Some of the terms we'll use are tracking error, and I'll explain each of these terms as they become pertinent during a discussion. We'll use the terms like tracking error, alpha decay, target risk, and dynamic asset allocation. We'll keep the presentation very simple. In very non-jargon type language. However, there will be a few terms like these that will be introduced, and we'll do our best to define them before we introduce such terms. So talking about the what if strategy, and this is usually a very common argument when you talk about buy and hold. If you had bought Apple stock back in 2008 and held it for 10 years, it would have yielded more than 800% in returns. If you had bought that same stock more than 4 years earlier from 2008, it would have been up more than 11,500%. Don't need to do any financial planning, don't need to do anything. But these are all hindsight decisions that we usually have regret that, oh, if I had done this and held on to it for a very long time, it would have been a great performance for my account. Consider this now. Had you invested in Transocean Limited instead in 2010 and held it in 2018, you would have lost $89 out of the $100 that you would have invested. Let's see what the returns would have been had you invested in Transocean in 2004. You would have lost only 67% as opposed to 89. However, that's still more than half your money. What I'm trying to stress on here is that when we talk about buy and hold, often we get into the storytelling of holding on to a certain position, a certain winner for a very long time, and there's a lot of selective bias there. Why are we not able to do buy and hold if buy and hold is really such a great strategy where you just need to buy something and hold on to it? There are many reasons for it, and that's kind of why we are having this webinar, to contest some of these what if arguments that we see many passive investors present to us. So I guess the first question that comes is, can you really have a long-term buy and hold strategy?
Okay, everyone, we're going to quickly jump into our first poll question. And just bear with me here. And the first question is, what percentage of your portfolio is actively managed? You could all select between the three options there: less than 25%, B, between 25 and 50%, or C, more than 50%. So what we'll do is let everyone take some few moments and go ahead and select their options. Okay, so we'll go ahead and close the poll now, and basically it's share the results with everyone. And it seems pretty much for majority of you, more than 50% has been selected. And I'll let Monsi go ahead and talk about that.
That's actually a fascinating result. It's quite incredible to see that, we all kind of agree that some percentage should definitely be somewhat active. And even though, you know, close to 50% of us chose more than 50%, to me, the interesting part is there is still like kind of an even divide on either side, which means there is some percentage of active investing in everybody's portfolios. And the percentage varies quite a bit. So we'll just just shift gears here a little bit and just take a look at one of the biggest portfolio that many of us idealize and follow his teachings. And we looked at a paper that was published in SSRN some time ago. It talked about Warren Buffett's investments, and they did a very good deep dive into all the trading activity that was posted through their SEC filings. And they looked at the trading history of about 26 years. And we have highlighted one of the tables here that discusses the holding analysis from the research report. And the interesting statistic to me was that in the long trading history of more than 26 years, only 20% of the stocks were held for more than 2 years. That doesn't look like long-term buy and hold to me. Even more interesting is more than 60% of the stocks were sold in less than a year. So what is going on? Let's just ponder on it for a minute. Obviously, he's one of the smartest investors that we all know, and many people follow his teachings. And one of his teachings are buy and hold. And I think what really this is being highlighted, what is being highlighted here is first, you want to buy and hold, but you have to be either a very good stock picker, have access to a lot of good information, and get rid of the losing trades really fast. Now, the moment I said all this doesn't sound like a passive strategy anymore. So what I'm really trying to stress on here is that you do believe in buy and hold, but that does not have to be a separate decision from how you do trade analysis. So where active investing comes in your entire investment process is the right question. The wrong question is passive versus active. That's absolutely the wrong question. The right question is, where does active investing contribute to my investment making process? And that is what we'll discuss in a little bit more detail further into the presentation. The other thing that we notice, I mean, not all of us have access to the same tools, to the same balance sheet, to the same information as Warren Buffett has. And majority of us are following some kind of goals, going through some kind of life events. And along with that, we see markets going up and down. And often those things don't happen, kind of in an aligned manner. So life does not follow a predictable path. And along with that, you have market volatility as well, markets going up and down as well. So that is why it becomes even more important to have an investment strategy that's evolving to your needs, but then also having a component in place that can manage your losses, that can manage that market volatility, that markets going up and down, while adapting to your needs and to your long-term goals. At qplum, we service many individuals and families, and this is kind of something we see over and over again, that clients are very focused on their long-term goals, doing everything right in terms of saving properly, in terms of investing, but then in the past they have worked with advisors or tried to do it themselves in a manner where they lack a very basic risk management strategy, which means they don't have any drawdown controls. They don't necessarily have a plan for markets going up and down. And a lot of times they need cash very quickly, very immediately, and now they have to liquidate, and they haven't really thought through how those two things would combine together. And that's where a good independent financial advisor can be of help. That's where active investing can be of help. Now, before I go on and on about active investing, I want to hone in on the point where I said, that the whole question that passive versus active, this whole question sounds a little bit of fuzz to me often. And the reason for that is here we have just laid out a few strategies. And I would really question that, is buy and hold really a passive strategy to begin with? Because if you start looking at the spectrum of strategies, what is passive and what is active? Even if you're doing just a strategic allocation, a 60-40 or a 70-30 or a 90-10, and you're systematically rebalancing, doing tax loss harvesting, taking money out based on your life events, or switching financial advisors as and when the need be, you're not really into a passive investing mandate. You are very much doing active investing just by merely rebalancing and doing tax loss harvesting. It's a very small degree of active management, but it is there. Similarly, when you are doing sector rotation, and sector rotation, for those who are not familiar, what it means is you are switching your allocation between stocks and bonds depending on some metric. The metric could be personal, could be like an age or financial need, could be more markets driven, that you don't believe that stocks are overvalued, or you believe that bonds are overvalued, and you are rotating the allocation. You're making some kind of an asset allocation decision. That again could be thought of as a passive investing, but then is also has some degree of active management in it. Traditionally, more active investing type strategies are global macro, trend following, carry, risk mitigation, relative value, and more recently deep learning, which is more data driven. The idea here, what we are trying to highlight is that as you move from passive to active, there are several reasons why clients make that transition. And while on the surface it might appear like, oh, my entire portfolio is passive and I only have a sliver of active, that might not necessarily be the case. When you are doing a simple strategic allocation with rebalancing and tax loss harvesting, that is also some degree of active. When you're doing indexing, that is also some degree of active. And really depends, what kind of investor are you? And the question should never be, which of these strategies should I pick? Because frankly, no one strategy works all the time. The last 10 years have been great for a simple 60-40 allocation, a 70-30 allocation, and global macro has suffered. However, if you go further back in the history, you will find favorable times for global macro. You will find favorable times for trend following. You will find favorable times for relative value when there is lack of direction in the markets. And no one strategy would work across all market conditions. And that is why if you are a forward-looking, a progressive investor, you would ideally want a combination of these strategies in your portfolio, irrespective of whether they are passive or active. As long as they are accessible, as long as they are at an effective price point, you should aim for having a good combination of these strategies, primarily because no one strategy works all the time. Very often when I talk to clients about changing market conditions and stress on the need of risk management, and I explain a systematic risk management, which is mostly based on drawdown control, often we get a response that, oh, I could buy options. And of course, you could buy options, but buying options is like buying insurance. And as we all know, in the business of insurance, the big winners are usually the insurance providers. Some of us who might have seen the tech bubble, and some of us who might have experienced the financial crisis know this firsthand, that options are not cheap. Options are fairly expensive, and you are paying a premium over a long period of time for protection for a very small part of the portfolio. Often they're not able to cover your entire portfolio. And while to some degree buying options makes sense and there is value to be derived from that process if you are a very savvy investor, a good start could be a very simple, disciplined approach. And the main motivation of this approach is often not so much to become a day trader suddenly, but it is to help limit emotional decision making. So we are not advocating for a stop loss at every 1%, every 2%, because in the end you are looking to grow your investments long term. However, you want to have a plan to exit and to re-enter the markets if things go extremely volatile, and having a plan before you need one is always a very good emotional anchor for the client, for your advisor. And it also, when you implement that plan, you have, kind of some knowledge that this is how I'm going to perform, this is how I'm going to act if things go south. My downside is somewhat limited. Of course, investment has always risks, but I have been able to come up with, these are the stop losses I'm comfortable with, and it's not gonna cost me so much to execute that disciplined approach. This is again something where active investing could be your good friend. Active investing is costly. It's not a costless option. It comes with execution costs, it comes with slippage, it comes with knowing when you want to execute, because you're effectively going into the market and setting a price, right? But what I'm really trying to stress on here is, when you think of active investing, just don't think of higher performance. Think of using active investing for implementing your risk management, and that way you can actually save on costs, because now you're using an active investing approach to implement your risk management strategy, and you're saving money that you would have spent in buying options, in buying puts, and overall you're building a healthy risk management plan for your portfolio. Another thing that we encounter with a lot of our clients is changing risk levels over their lifetime. And every person is unique, and every person has a very different situation that they have to deal with. So a lot of times a usual glide path, as many advisors call it, is not sufficient. Yes, overall, before retirement, your goal is wealth creation, and as you hit the golden years, post-retirement, you're looking primarily for protection from inflation and capital conservation. That said, we have had so many instances where we find very young clients who are actually focused on capital preservation very early on in their lives, and that is just because they've either created a lot of wealth very early on and they have a lot of responsibilities that they have to take care of. On the contrary, we also see situations where we have people who are retiring, close to retiring, and they are still focused on wealth creation due to a lot of personal reasons. Another thing that has recently been a big cause of worry for many of our clients has been the state of the markets. We all know that savers are not being rewarded, savers are being penalized. Long-term yields are so low that the usual projections that are given out by financial services firms are saying, hey, as you age, you should have more bonds and less stocks. But you know what? I don't want to have more bonds and less stocks. And that's primarily because nobody has ever seen a scenario like this where bonds are at such low yields. And that worries me. And the point that these clients are making is actually quite fair, that if we do face a situation where inflation just picks up very, very fast, I'm actually not better off having a lot of bonds in my portfolio just because I'm over 65, because those yields will not come back in one lifetime. And it's probably a better deal for someone very young, but for someone who's just looking to retire and looking to access his wealth in 5 to 10 years' time, that's a very high risk to take. A combination of personal factors and a combination of the unique market situation that we are in, again, leads to this factor of active investing, where we are forced to look for alternative strategies that can compensate for the lack of yield that should have been coming from long-term bonds. And this is not just the case with individuals, this is also the case with institutions. We are also seeing this problem with foundations, endowments, and pension funds, where they're not able to hit their target yields, and traditionally long-term bond would have done the job for them. But in an environment where rates are so low, they are forced to look at these alternative strategies. And yes, they would either look at it as a sliver of active portfolios that could just enhance the yield, or they are looking at it more from an asset allocation perspective, where they are saying that, well, you know what, I'm just going to revisit my entire asset allocation and see how actively I can change the asset allocation. And I'll talk about dynamic asset allocation in a little bit in one of the following slides. We talked about two very important factors here. So we first talked about how one can rethink use of active investing for risk management. And then we also talked about use of active investing for your asset allocation. Now, before I go any further, I want to stress on this, that if you are in a pure buy and hold, the what if strategy, as we called it during the beginning of the presentation, many of these factors can still be applied as an overlay. For those of us who have gone through market crashes and have kind of witnessed them firsthand, there is one argument that is effectively made is, it's much easier to cut down losses. It's so much harder to go back into the risk-taking mode. And when people talk of compounding, which is another very popular argument we see from the buy and hold investor community, we see a chart that shows, hey, if you buy something and if you hold on to it, it compounds and you see a lot of returns. On the flip side, there's a very long road to recovery from a market crash. If you don't have risk management in place, if you don't have some kind of a systematic plan in place, if you don't have dynamic asset allocation in place. Here we demonstrate an example that hypothetically, let's say if your market, given the market conditions, if your portfolio value goes down by 50%, somewhere around 2008 due to the financial crisis, even if you have a healthy 8% return every year, it would take you roughly about 9 years to recover to just the original account value. And this is kind of almost an idiosyncratic flip side to compounding, that if you didn't have a proper risk management in place to begin with, if you didn't have dynamic asset allocation to begin with, and you just left it to be buy and hold, it would take you much longer to recover than otherwise.
Okay, so I think at this time we will go ahead and launch our second poll question. And just bear with me for a moment. Okay, so the second poll question is, what do you use active investing for? And everyone can choose between for higher returns, for a risk management plan to protect against market. Option 3 is for asset allocation decisions. And then the fourth option is no use of active investing at all. So we'll give everyone a few moments to go ahead and make their selections. Okay, so at this point, we will go ahead and close the poll and share the results with everyone. And an astounding number of you guys have selected option for high returns. I'm not surprised, right?
Yeah, I agree, G. I mean, it's kind of an expected response. I appreciate that people took the time to take the poll, and that's kind of the one of the main reasons we chose this topic, even though on the surface it's very controversial and you see a lot of mainstream media talking about low cost passive investing and benefits of passive investing. It has kind of been unfair to active investing that, oh, if you want active investing, just dedicate a sliver of your portfolio, because most of it you want to just track to an index, and the rest of it should just be passive. And that sliver should do all the job of finding higher returns for you. What we are really challenging here, the core philosophy, that there is no such debate of passive versus active. You have lots of products to choose from, and it's mind-numbing. You have more than 1,700 ETFs in US alone. And if you were to be a passive investor, you're still having to make some sort of active management decisions, as we mentioned, either around rebalancing, either around sector rotation, or either around life events. So we'll just slow down a little bit here and just discuss, especially focusing on the poll results that we just got, that majority of us use active investing for higher returns. We could use active investing for reducing costs. I know the moment I say the word active investing, most of us assume that it means higher trading costs, that means it means higher manager fees, and that it means some sort of trading mandate where I can only dedicate a part of my portfolio. It does not necessarily mean reducing costs. And I want to challenge that. I'm very fascinated to see that 11% of the attendees are suggested that they use active investing for asset allocation decisions. And at qplum, we are a big proponent of that. And we're going to cover that in a little bit more detail on this slide. So I'm going to introduce a few terms here, as I promised earlier in the slide. Some terms I'm going to talk about are first dynamic asset allocation. What dynamic asset allocation means is allocation is changing over time. You shouldn't have to decide whether your asset allocation should be 60% stocks, 40% bonds, or 90% stocks or 10% bonds. That is a very hard decision to make. As has been written and proven by a lot of researchers and also has been advocated by a lot of CIOs from pension funds, we have seen time and again that asset allocation decision drives 90% of your performance. Security selection or manager selection drives only 10% of your performance. Even despite knowing this in principle, many individuals and even institutions end up spending a lot more resources on manager selection, on security selection. And that is primarily because use of active investing in their asset allocation decision making is missing. Another term we would like to introduce is active risk. So when I say active risk, it is also interchangeably used with tracking error. And you will see some more kind of institutional type asset managers use this term, active risk or tracking error. And what it really means is, how are you going to gauge all these different portfolio managers, all these different strategies? And what the reasonable way to think about it is, returns are not guaranteed, right? Nobody knows which strategy will produce higher returns. However, all of us want higher returns. So the right way to gauge these different strategies is by saying how much risk they are taking. And if an investment manager or a strategy is closely following the benchmark, then their active risk is fairly low. If they are taking more risk above and beyond the benchmark, then their active risk is fairly high. And that is a metric that people have quantified over time and look to compare two asset managers or two investment strategies. So we defined two terms so far. One was dynamic asset allocation and another was tracking error or active risk. One more term I would like to define before we go further into this slide is alpha decay. And strategies come and go, as I highlighted earlier. No one strategy works all the time. You might have a manager or a trader and come and say, you know what, I have an edge. However, that edge is time dependent. It depends on the market conditions. It depends on availability of data and information. It depends on trading capabilities like execution and commissions, slippage, and things like that. So alpha of any strategy would decay over time, and that is again something you want to quantify when you are evaluating an active management strategy purely for higher returns. Now let's come back and see how can active investing reduce your costs. If you're rebalancing, you're already doing active investing and you're already reducing your costs. Tax optimization, which is something we spend a lot of time on and a lot of effort of our asset management team goes in doing this for our clients, especially for the taxable accounts. Tax optimization is a classic example of how active investing can reduce costs. Using technology, you can do specific lot matching, which allows you to pair specific buys against specific sells, and that enables you to lower your tax bill while following the same strategy. So again, let's pair rebalancing with tax optimization here. You have to sell something, and all you have to do is just pair it against the right buy so that your tax bill is lower. I know Interactive Brokers provides a lot of useful APIs, and they have an amazing trade workstation, and we at qplum also use Interactive Brokers for our services to clients. So they have a very good platform, and they're very transparent, and they allow us to use many tax optimization algorithms for our clients when we rebalance or even otherwise when we trade actively for our clients' accounts. Another thing that comes into mind the moment you think about active investing, as I mentioned earlier, is trading costs. However, good trade execution actually can reduce your costs. And this is where, again, you have to be very careful when you're evaluating an active strategy or a trader or an investment manager who's promising some kind of higher returns. How dependent is it on trade execution? Not every active investment strategy is dependent on trade execution. I'm going to pair it here with dynamic asset allocation. If you are using dynamic asset allocation, which means every day your system, in our case, we have a deep learning framework, so I'm going to go with that example. Our deep learning framework is looking at market conditions, is looking at market data, and deciding what is the optimal asset allocation, what is the optimal percentage of stocks, bonds, real estates, commodities that your portfolio should be allocated to, and executes that asset allocation for you. That can actually result in reduced costs over time, because then you're not going to have to chase a very high fee asset manager for that sliver of your portfolio who's assuring you higher returns to begin with. Majority of your returns are getting derived from asset allocation. One very important factor that I want to highlight while we are on this slide is when somebody is switching financial advisors or changing strategies. And we see this time and again that many clients feel comfortable spreading their assets across multiple advisors or multiple strategies, and then they assume that they're just going to gauge and watch for 6 months to a year, and that way they will know where should they consolidate their assets. First, comparing two different advisors or two different strategies is like comparing apples to peaches. It's not an easy comparison, and any amount of time is going to be insufficient. If you watch it for 6 months, watch it for 1 year, it's dependent on so many other outside factors that are not in your control, that your decision would not be objective. The right way to look at it would be, is it doing dynamic asset allocation for me? Is it doing optimal trade execution for me? Is there rebalancing? Is there tax optimization? And where is the use of active investing coming from? Is it coming because they're going to just charge me a very high fee product, or are they going to use active investing for asset allocation and risk management decision making? The financial services industry has kind of matured to this size because of the number of products it has. And it is a very classic case where the service provider is actually incentivized to introduce more and more products. Um, they are not incentivized often to just tell you that, hey, you know what, all you need to do is just know what your asset allocation should be. And that is where active investing could just creep in and save a lot of money for you, save a lot of time for you, um, and allow you to actually take advantage of things like tax optimization. Now, as I mentioned, there are 1,700 ETFs in US alone. There are a few thousand active managers, and often you hear terms like, I'm going to kind of give you some kind of a higher return if you allocate a sliver of your portfolio to my active investing strategy. So when it comes to selecting active managers, we recommend looking at the following. We recommend identifying the source of alpha. By that, I mean we go back to what I discussed earlier, terms like tracking error or active risk, whether it's a data-driven decision-making process or whether it's fluke, whether is it just based on some kind of market environment which worked in their favor, or whether it's a systematic process. And it doesn't have to be written in an algorithm. I've worked with discretionary traders. I've worked with macro traders. When I was at Brevin, there were many senior experienced traders who were not so comfortable with use of technology, but mentally they had a system. They couldn't quite explain it, but as a junior portfolio manager, I was learning from them because I could see that even though they think that it is their intuition or it's their gut feeling, there is actually a system behind how they are making those decisions. So identifying that source of alpha is extremely important when you're selecting an active manager. When you're evaluating different active managers, the another thing to consider is fees and where does it fit in your overall asset allocation. I know probably if you go through this webinar and search the term asset allocation, you will find me mention it like more often than any other term, but it is the most underappreciated part of asset management, and that is why we stress on this quite a bit. With that, I think G wants to switch us to another poll question, so I'll just hand it over to G.
Thanks, Mansi. So at this time, what we'll do is go ahead and share the last poll question with everyone. And last poll question is, high tracking error of a portfolio means high active risk and hence a more actively managed portfolio. Now, all of our attendees could select between true or false, and we'll give everyone a few moments to go ahead.
G, I believe you might still be muted. Would you unmute your phone?
Okay, everyone, thank you for taking the last poll question. And An overwhelming number of you have selected false, and I'm just going to see if Monse has any feedback on that. No feedback. All right, so we'll go ahead and resume the presentation.
Before we conclude the presentation, as I mentioned in our topics to be discussed today, I do want to stress on one other myth that we all have about passive investing, which is on average, US households believe in passive investing much more, are traditionally more buy and hold investors. And here we have pulled some data from Federal Reserve. Federal Reserve makes this data available for free through their FRED database, FRED. And it is quite interesting to us that they provide all this data in a fairly exhaustive manner, and yet it is not utilized by asset managers to the same degree that it should be. If you look at the asset allocation here, you would actually find out that US investors are quite smart. They have good drawdown control in place. You see big asset allocation changes. Specifically, you can see on the bottom left, the stock allocation has dropped dramatically and then, peaks pretty well, quite fast after the recovery. You also see real estate allocation, which also explains the financial crisis a little bit. And while we don't have that chart here in the presentation, if you go to our US Investor Index webpage on the qplum's website, we also share a more detailed research report on how US investors behave quarter over quarter and actually make quite good trading decisions. We also did a research on this, which we kind of published as an op-ed on MarketWatch some time ago, where we compared what asset allocation changes a US investor is making versus average hedge fund returns. And what we found out was US investors are beating hedge funds. So if you ever have questions about the whole concept of whether asset allocation derives most of the alpha or not, I'll be happy to share that piece with you. The one thing I want to stress on when looking at this, and it took us quite a bit of time to clean this data and to kind of get it to a point where we could make a US investor index out of it and track the asset allocation changes, because you do get revisions and you have to account for the raw data and the revisions accordingly, is that what we are observing is the allocation to equities at this time is peaking and has never been this high before, relative to the net worth that people have. So as a percentage of net worth of clients, the allocation in equities is very, very high. And despite all the recovery that is being talked about in the real estate market, it's nowhere close to the levels that it was pre-financial crisis. So just some anecdotal evidence that is of kind of interest to us as asset managers. With that, I'll just stress again on the main motivation we have here in proposing another look at active investing, not as a tool to deliver higher returns, but as a tool that can deliver dynamic asset allocation, that can participate in your risk management strategy, and that can reduce costs of asset management for you. It comes from Benjamin Graham, who wrote in his paper back in 1952 that security analysis may begin modestly but hopefully to refer to itself as a scientific discipline. We believe that investing could be a tool where we are relying more on data-driven decision making and not looking for those star traders, for those rainmakers who will just deliver a very high return proportionate to the rest of our portfolio. Yes, there was a time when there was information dispersion, high information dispersion, and this was possible. But now with the electronification of the markets, cheap computation, and so much data, it is very much possible to start looking at investing as a science and not as a game. With that, we would conclude our webinar, and we would welcome any questions people have.
Okay, so we do have first question is from Zabrad. The question is using options a purely active strategy, and does active contribute to risk?
That's an excellent question, actually. So yeah, I mean, I've traded options back at Wachovia Bank and also at Merrill Lynch, and traditionally options involve a lot of active trading, just because, say, you are doing options for risk mitigation, for example, then probably you wouldn't trade against the options as much. So then it would be slightly less active. But typically when we see people trading options, they're looking for some kind of a higher yield. And that's why it is usually falls into the bucket of somewhat of an active trading strategy.
Okay. And then let's go on to another question. Okay, so this question comes from, sorry if I mispronounced your name, but Sabher. And the question is, what is best to study degree-wise for quant?
So I graduated a couple years ago, so I might not be the best person to answer this, but from what I'm seeing in the industry right now is that if you can find any coursework that talks about use of machine learning, use of deep learning, that's kind of the right direction, more forward-looking direction to go in. Just because the old form of quant, which was more focused on stochastic calculus, is still relevant. However, it's definitely not able to cover a lot of new market shifts, and a lot of the past assumptions are getting broken. So definitely something to look for if in your school they offer a course on deep learning or machine learning.
And so I have a general question for you, Mansi. And so I know that, you know, there has been debate between active investing and buy and hold. And has there been, you know, tested comparison between the two, let's say using the last 20 years of data, and see if, you know, if active investing would beat out buy and hold?
So that's kind of the most common question we get from clients. Gee, thanks for that question. So it comes back to the what if strategy that we highlighted in the earlier part of our presentation. That's kind of the classic question we get, that, hey, what if I had invested in this stock starting from this year? It would have outperformed what you have for me. Or what if I had invested in Apple and put all my money in Apple back then, and it would have just grown so much? And that is what I want investors to be very careful about when they're looking at backtested performance, either by qplum or by any other asset manager, is that first of all, you wouldn't be able to follow through on something like that. You wouldn't be able to follow through on a pure buy and hold strategy due to a combination of life events and due to market events. And then I can always find the right start date to show you favorable results. And that is something to be very careful about, because how you evaluate buy and hold is extremely sensitive on what your start date is. That is why when we perform back-tested studies, we always use walk-forward optimization, where models are reevaluated and regenerated every day. So I know it's a kind of a long answer to your short question, G, but just comparing the two would be, again, as I said, comparing oranges to peaches, and not a fair comparison. The right way to think about active investing is to see how can you incorporate it in your asset allocation, how can you incorporate it in your risk management strategy, and how can you use it to reduce costs, maybe through tax optimization or through trade execution algorithmically.
Um, Thanks, Mansi. Okay, and then we have another question from Do. Do quant funds have a buy and hold strategy?
Everybody has a buy and hold strategy, some part of it. So when you are buying and selling products, of course, you're going to hold on to some products long term and some products short term. So some component of your portfolio will appear to be buy and hold. However, that said, most quant funds focus on combining different strategies and producing a more, how do I say it, a market resistant portfolio where they can withstand different market seasons.
Okay, and then we have another question from Kevin, and the question is, do you offer services for retail investors or only institutions?
Gee, I think you can answer this.
Yeah, so we our services are available, Kevin, to both retail investors as well as institutions, pension funds, endowments, family offices, and other investment advisors. Thank you.
And then for retail investors?
For retail investors, they could come right onto our platform and just open an account with us to be managed with either, we are integrated with 3 custodians, Interactive Brokers being one of them, of course, and you could just open an account directly on the platform. Okay, so I think this will conclude our presentation today on active investing versus buy and hold. So thank you all again for joining us today, and I just wanted to send a reminder that qplum offers AI-driven active investing for individuals and their families at a low-cost flat fee. If you have any questions, please send any inquiries to us at contact@qplum.co. And I also wanted to another reminder that we will be hosting another webinar in collaboration with Interactive Brokers in August 9th, and we will be discussing the use of ETFs. So at this time, Cynthia, I will hand over the closing remarks over to you. Thank you, everyone.
Okay, well, Dee and Nancy, thank you so much for today's information. Great background, and we do appreciate the time that you've spent with us, and also want to thank everyone for participating with us here today. I do want to remind you we have been recording today's event, and we'll be sending out a direct link to today's recorded playback as well as the associated slides later on this afternoon. So watch your inbox. So with that, we are going to be concluding our event today. Now, before I do mention conclusions, I also do want to point out that qplum has been a very active webinar in our webinars, and I do want you to know that those webinars will be or are available on the Interactive Broker site. You can find them underneath the education menu. Go to the webinars section, and then you'll be able to locate them as well by sponsor. So simply type in qplum in your search, and you'll find a host of events that have been brought to us by qplum. So with that, we are going to conclude our session here today. You can exit using the X in the upper right-hand corner of your screen. Have a great rest of your day, everyone, and thank you.